Hey, Denise here. And what I want to share with you today is a little bit of a sad story, but this is the renewal reality. So, this is why some homeowners do not have options at renewal and others do. Okay. So, I want to take a closer look at the 2012 rule that's boxing people out of refinancing and what that means for you. Before we start, this is a QR code that you can download our mortgage app. So, this will give you interest rates, what we're seeing in the market, calculators that you can play with so you can run different scenarios. Obviously, we will do that all for you for free as well, but some people want to play with some numbers themselves. So, this is a great place to do it, and it is absolutely free. There's also our phone number and our email. If you have any questions about anything in this presentation or anything mortgage related at all for residential or commercial mortgages, give us a call. So, this isn't just a feeling, right? This is actually what the Bank of Canada confirms. So, 12% of all outstanding Canadian mortgages are pandemic era 5-year fixed loans renewing in the next 12 months. And 15% average payment increase is what most renewing borrowers are going to be facing on top of their already stretched budget because everything is expensive these days. And 9% of Toronto area borrowers renewing in 2027 might not qualify for refinances due to what has happened with home values, especially when we're looking at condos. And 12% of Toronto area buyers are locked out of refinancing if home values drop another 10% as we go here. So, why does this renewal hit differently? Rates have jumped, not just crept, right? So many 2021 buyers locked in around 1.5% to 2%, and today's renewals are landing about 3% higher for the same loan. And everything else got more expensive too. So gas, groceries, insurance, everyday costs climbed right alongside their mortgage. And there's less room to absorb bigger payments because guess what? Our incomes did not increase by the same rate as our expenses did. The bigger problem here is that home values have shifted underneath them. So in some markets, homes are worth less than what people purchase them for. And that changes what the homeowner qualifies for through no fault of their own. So what a refinance can actually do. So this is a tool that helps a lot of people. So a renewal simply carries your existing loan forward with your current lender and the current terms, right? So nothing changes. We have a 25-year mortgage that we took in 2021 or 2022. And when it comes up for renewal, it will be a 20-year mortgage. It will stay the same, new interest rate, quite a bit higher, but you paid down a bit of debt. So it will be calculated on less outstanding balance. But overall, those payments are going to be on average 15% higher. So with a refinance, we can stretch the amortization out. So we can stretch to 30 years with A lenders, and with B lenders, we can go to 35 or even 40 years with some lenders to lower the monthly payments. We can also roll in high interest debt like credit cards into the mortgage at a lower rate. And we also shop the whole market instead of just accepting what your lender is offering. So here's the catch. Refinance is only available if you own 20% of your current home's value. So not what you purchased it for, what the current value is today. So that's that your mortgage has to be less than 80% of the current value of your home. So the rule that's boxing people out, so in 2012, the federal mortgage rules tightened the maximum refinance amount from 85%, and it actually was 95 before that, down to 80% of the current home value. That's 80% loan to value cap is still the rule today. So in practice, that means if your mortgage balance is less than 80% of what your home value is worth right now, not what you paid for it, but right now, then refinancing is not an option for you. There is a catch. Obviously, there are exceptions for people who have documented spousal buyouts right after separation that we can treat as a purchase, but everything else, refinance may or may not be an option. So if you own more than 20% of your home, you could qualify for a refinance, which means longer amortization and debt consolidations are on the table for you. But if you own less than 20% of your home, refinancing is off the table. So even if it would clearly leave you better off, the renewal with your current lender is really your only option. So that's great for the bank and not so great for your cash flow, right? The reality is refinancing, when it's not allowed, that high interest debt doesn't disappear. It stays right where it is and compounds at a rate that most mortgages haven't changed in decades, but the mortgage itself sits untouched at a much lower rate, right? So you think about $10,000 stuck on a credit card at, let's say, 21% interest, but the reality is some of them are 29 or 30% interest. That will cost you $175 a month on interest alone every month, just one balance. And if it was rolled into your mortgage at, let's say, 5% interest, which I think is, overreaching because most rates are in the high threes or fours right now. We're talking $41.67 a month. Instead of that 175. And this is only for $10,000. The average Canadian is carrying more debt than this. So I want to give you two scenarios of examples of real clients, which obviously we've changed a bit of the details so that we can keep them confidential. Okay, but equity opens the door. So this is an example of clients who own 50% of their home. So at renewal, the client is carrying a mortgage of 670 and 41,000 in high interest debt. And what they're paying right now per month across all of these is $5,865. And because the client owns more than 20% of their home, we have three refinance options for them. So one would be the 30-year amortization with an A lender, which would put them at $3,828 per month. We could go to a B lender at 35 years, which would be $3,748 a month. And we have an option with a B lender for 40 years at $3,584 and 59 cents per month. And every single one of these options saves the client money. So holding on to their lower legacy interest rate mortgage, but their high interest debt is costing them more overall, like globally, than it would be for us to clean this up into one lower interest rate mortgage, right? This is going to save at least $2,280 per month. Think about how much breathing room that gives for a client to consolidate that debt, and actually what they could do even if they continue to pay $5,865 each month, but put that as an extra payment on the mortgage. Well, now over $2,000 a month would be going to your principal to actually pay off your mortgage instead of just going to interest. And here's another example of a client who owns less than 20% of his home. So he was a first-time buyer that bought a condo in 2021. The condo was $490 when he purchased it with 5% down, and today it's worth about $380. And that might even be generous. Because a home is worth less than the mortgage balance, a refinance is not an option. Renewing with the current lender is the only path forward. And you know what really sucks is for this person, at the time they purchased, 25-year amortization was the highest they could do. Today, a first-time buyer can do 30 years. But this person, because they bought during the 25-year cycle, they don't even have the option to extend that amortization out a bit, because when they bought at 25 years, now 5 years later, their renewal is going to be offered at 20 years. So what does that renewal look like? Well, the only path available for them would be to do a renewal, and that would cost around $2,675 per month. Right? If they hadn't been able to do that 30-year, it would have been cheaper. And if we look at if we were able to refinance this person and stretch them out into a 30-year amortization, then their payments would be $532.88 less each month. But we're not able to do that. So that's actually what they're paying more. This is $6,394.56 per year as long as this renewal term lasts. Okay, so what do we want to talk about here? So what do you need to do before your renewal date? We need to find out what your real equity position is. So we'll look at your current home value and your mortgage balance so you know exactly where you land on that 80% line. Months before renewal, it's important to evaluate if this is an option or not. Then we will look at every single option, right? Not just a renewal offer from your current lender, but do we qualify for a refinance? If so, what does that entail? How much money does it save you? And does it make sense? In most cases, if we're carrying high interest debt, it is going to make a lot of sense to put that into a lower mortgage payment so that your monthly cash flow is improved and you're able to actually attack your mortgage and pay off your principal faster with the same amount of money coming out of pocket each month. What I want you to do is not to just sign your renewal offer, right? Even if refinancing isn't available to you, there's still maybe other ways to ease the payment. And we will tell you honestly and realistically what is and isn't possible. But even just having the renewal offer and coming to us and saying, here's what my lender is offering, is that comparable with everybody else in the market? Even if the minimum we can do is keep them honest and push them to offer you what their real rates are on the back end that we can see, it's still important to have those conversations to save the most money possible. So, what I want you to do, never be too shy to reach out. If your renewal is coming up and you're not sure where you stand, let's look at the whole picture together before actually signing that renewal offer with your bank. We are happy to help. Our service is free, our advice is free, and we would love to make sure that anybody who doesn't have options knows what their options are in the future as well. And so that we can mitigate these renewals coming up in the best way possible. So if you have questions about renewals or refinances, please let us know. And please don't assume anything. Like, let's actually talk about real numbers, what we're seeing in the market, and what our appraisers are actually reporting as real values at this point in time. Okay. Thanks so much. I appreciate you spending this time with me. And again, if you have any questions, let us know.